So remember how this fear greed index was in the extreme fear category just a few weeks ago? Yeah, it's not even close to that right now. We're in a greed category on the way to the extreme greed category right now, and everybody's piling their money into the stock market as if it's never going to go down again because we got one trade deal with the United Kingdom, and now all of a sudden the economy is going to be okay, interest rates are going to probably go down, inflation's going to go down, all this good stuff's going to happen out there in the economy. So yes, the stock market's going to go straight up. 100% incorrect and wrong. It is a trap out there right now. Do not invest your money right now in the stock market unless you watch this entire video from start to finish to really understand the state of the economy and the state of the stock market, to know the most likely situation for the market, because I'm going to be honest with you, it's probably not going to be up for the rest of the year. It's probably going to be down, and I'm not trying to scare you guys and be all bearish right now, because you guys know that I'm usually bullish on this channel, but there are some bad things that are popping up in the economy right now, and some very, very bad things that are popping up for the stock market and these companies, as to why it's very, very likely that we're actually going to fall from here going into the end of the year. I'm not making this video to scare people. I'm not making this video to get views or really have everyone like watch to the end like everybody else wants you guys to do. I'm here to lay it down for you straight up about what's actually going on in the market. And this little rebound right here that's happening in the market is actually very, very concerning, because the NASDAQ ripped from April 8th to May 8th over 17% in just 1 month. I get it that the market went pretty much straight down, but now the market is going straight up and everybody's just piling their money in stocks like Palantir and piling their money into the NASDAQ, thinking that the market has all this upside left to go. Maybe it does, but maybe it doesn't, because there's some massive, massive problems right now with the economy and the stock market, in particular the stock market valuation, that's going to be very, very hard for the stock market to keep going higher. So we're going to break all that down in this video. It might be a boring video for you, but by the end, you're going to know exactly what's going on in the market, and to see inside my $1 million account of some of the trades that I'm making right now to capitalize on this dip, to capitalize if we go down lower, and to capitalize if we go higher. So this chart is honestly very, very bad, and this is the exact reason why Trump initially did the 90-day pause on tariffs, because this chart was getting completely out of control and the market was potentially going to crash and the bond market was going to totally collapse. So Trump had to do something. So this is a chart of the 10-year bond yield, and right now we're yielding roughly 4.36%. But if we look just a couple years ago, take a look at this period right here, 8/2 of 2020. The 10-year bond was yielding roughly 0.5%, a half of 1%. So literally, if you put $100,000 into a 10-year bond, you're going to get just $500 per year as a return on your investment when the bond yield was at 0.5%. So who on earth is going to want to put their money into a bond that's only yielding 0.5%? I'm not going to want to do that. You're probably not going to want to do that either. So bonds were very unattractive in this period over here. But as you can see, the bond yield went pretty much straight up, because as inflation started to get totally out of control, the Fed started raising interest rates. As inflation went up, the bond yield went up, and now we're all the way here at 4.37%. So the fear from investors right now is that the damage is already done with regards to these tariffs, and inflation is going to come back whether we like it or not. Even if we make a trade deal right now with every single country on our list, the damage might potentially already be done, and inflation is going to come back whether we like it or not. And when inflation comes back, the Fed is going to have no option but to raise interest rates higher to try to bring inflation down. But when you raise interest rates, you're taking from the economy, you're going to slow down the economy and potentially throw us into a full-blown recession, and that will be very, very bad for the market. The whole market could totally collapse. So to show you how bad this could actually be for the stock market, we have to look back in time to the last time that this actually happened, where the economy was slowing down, but inflation was going straight up. So this is called stagflation, and honestly, it's very, very rare. But the similarities to the market right now, to the similarities in the market in 1968, which is when this happened last time, they're very, very similar, could very well mimic and mirror exactly what happened back then. So back then, the S&P was $979 per share, and you could see in just a few years, the S&P went all the way down to $401 per share. So over a 50% stock market drop, almost a 60% drop in the S&P 500, because of one thing and one thing only. The economy was going down the tubes, and as you could guess, inflation was pretty much going straight up in that same time period. That chart started on 1968. Inflation was at 4.2%, which is a little bit higher than the Fed's target of 2%, but it's not astronomically high. And then you could see inflation went from 4.2% all the way up to 13.5%, which is absolutely bonkers. It's absolutely nuts how high inflation went in that time period. So inflation went very high, the stock market went way down, and the Federal Reserve had to act like crazy. The Fed was in this very tricky position of, Do we lower interest rates or do we raise interest rates? Because the economy is taking a crap, so we want to cut interest rates for that. But if we cut interest rates, inflation is going to go actually way higher. So if we have this period right now where inflation gets totally out of control and the economy goes down the tubes, usually the Fed is going to go pick to try to get inflation back down because inflation is what ruins countries. Usually recessions do not. So you can see starting at the same time period, 1968, the Federal Reserve interest rate was at 5%. Inflation was getting totally out of control. So they had to raise interest rates from 5% all the way up to 12.9%. And then there was a second wave of inflation that came again, and they went all the way up to 19.1% on interest rates. It was totally out of control. So when I tell you guys that interest rates are like gravity on the stock market, it's because they really are. Interest rates are everything because money always wants to find the best risk-adjusted return. So if you could get a guaranteed rate of return of 19% in a bond or a risky rate of return in the stock market, which is typically 10 to 12% per year, nobody on planet Earth is going to want to put their money into the stock market. The stock market's going to completely collapse. So that's why it did. It exactly did that. The market went straight down in 1970 and 1980. Massive recessions happened, massive crashes happened, and people lost a lot of money. So is that possible to happen right now? Of course. But now we're going to flip to the bullish side. I'm going to put my bullish hat on right now and say what actually is probably going to happen, because that whole situation I just laid out right now is a worst case scenario bearish argument that honestly, if I had to put a percentage on it, I would say it's roughly, below 20% chance for that to happen. But the 80% chance, what I feel like is actually going to happen in the economy is this. I'm in the camp that we're on the brink of a massive tech and AI revolution right now that's going to completely change the economy and all these companies, how we look at them going forward. When that starts to materialize, I expect these companies to be more efficient, costs are going to go down, and when that happens, the productivity of these companies are going to go up, and when that happens, they're going to need less human labor, and when that happens, the cost of labor will go down. So basically what I'm getting at is there's all these negative inflationary pressures happening in the economy right now, but of course on the flip side, tariffs are an inflationary pressure, but I do think that the trade deals are going to get worked out eventually. I think it's all going to get settled down, whether we make a trade deal or not. I think that, trade deals will go through, or we're just going to have reciprocal reduction of tariffs, which I talked about in my videos months ago before this even happened. I expect that we're going to have reciprocal reduction of tariffs. We're just not going to make deals. We're just going to lower our tariffs all the way down to a certain level and then try to make negotiations from there. So if we throw the tariff situation out and forget about it, whether we assume that we make deals or we just get reciprocal lowering of tariffs, now we're going to focus on the economy and what's actually going on. So these companies are making a lot of money. They're becoming more efficient. AI is going to help them be more productive going into the future. That is deflationary pressure right there. So when inflation goes down right now, which it is going down drastically, remember, we came out of COVID and we went all the way up to 9%. And now we're down here at this level of 2.4%, which is great. And the Fed's target is 2%. So we are very, very close to target. So as inflation continues to trend lower, the Fed's going to be more confident to cut interest rates and lower interest rates down. What happens when we lower interest rates? The bond yield's going to fall. What happens when the bond yield falls? It becomes less compelling for people to want to put their money into a bond. So what are you going to do with your money? You're going to put your money into the stock market. But there's an issue with the stock market right now that maybe valuations are a little bit expensive and maybe you shouldn't put your money in the stock market at all. Maybe you should just sit on your hands and wait. And I know I talk about this chart a lot on the channel, but it just got a very, very important update that we do have to talk about. So the red line corresponds to the S&P 500 and the blue lines correspond to the PE ratio, the price earnings ratio of the S&P 500 if it was trading at the level of the blue line right here. So why do we care about the PE ratio? Well, the PE ratio is just like how much profit these companies actually make in relation to the share price. So it's a very, very good valuation metric to really just understand how much money am I paying for the share and how much profit are they getting per share. So it's very, very important to understand the PE ratio of the S&P 500. But going all the way back to 1985, you could see the middle ground of the PE ratio. If you average all this together on the red line, it's going to come out to roughly 17. And right now we're at roughly 21. So the market is a little bit expensive. And even if inflation goes down and interest rates go down and we make all these trade deals, yes, it could be good for the economy and CEO confidence and consumer sentiment and really just sentiment of everybody. People might go pile their money into the stock market even harder than what they're doing right now. And this is probably going to expand even higher to a PE ratio up into 23, 24, maybe even 25 range for the S&P. And the last time that we expanded into that territory was back here in the dot-com crash. And we all know what happened after the dot-com crash. So historically, when the valuation's up in this territory here, expect lower returns for the years going forward. And when the valuation's in this level right here, expect very good returns in the years going forward. Because look at this, the bottom of the 2008 great financial crisis, the market did a massive ripper all the way since 2008 to right now. I mean, yes, we had bumps along the way, but the market overall did a very, very big move. But look, if you had invested in the S&P 500 in the time period right before the dot-com crash, it would have taken you all the way from 2000 going all the way to the right to 2015, roughly 15 years. Think about it. 15 years for you to get even on your initial investment if you would have piled your money into the stock market at this high valuation level right here. And to be completely honest with you, we're not super far off from that valuation level. So am I calling the market a bubble right now? Absolutely not, because the earnings of the companies within the S&P 500 are growing like crazy, and I do expect inflation to go down, which means interest rates are going to go down, but you have to be very, very careful right now. If inflation goes up, interest rates go up, the stock market's going to have a lot of pressure to go down, because I feel like right now the market knows that it's expensive, and whenever we get any negative catalyst, it's like, boom, market's horrible, market's going to go straight down. But when we get a lot of positive news right now, it's kind of like, okay, great, we got good news, but the market's kind of priced in a little bit lofty right now, so the market's just not going to go up as much. So what am I personally doing in my $1 million account right now? Well, you're probably going to guess what I'm going to say. I'm going to continue to dollar cost average into my base portfolio, which is VOO and Triple Q, which is the S&P 500 and the NASDAQ. I'm usually always a net buyer of the base portfolio, but when we have valuation levels like the end of 1999, I'm not going to put much money in the S&P 500 because it's crystal clear that the market was a bubble then. Right now, yeah, valuations are a little bit lofty, but it's not like it was back then. Interest rates are way lower, like I said, right now, and these companies are actually making a crap ton of money, and the profits are expected to continue to go up quite a bit. In 1999, anything with a .com behind the name, they weren't really making any money. It was just all hype and FOMO going into the market. So the market did deserve to crash back then. And really, the main reason why the market crashed is because of the NASDAQ. The NASDAQ is a tech-heavy index, and that index hit a PE ratio of over 200. It was totally nuts. Now, with regards to stock options, because I know a lot of you guys follow this channel to get insights onto what I'm doing with stock options, on the dip that we just had a few weeks ago, I sold a bunch of puts on Triple Q. I sold some puts on Meta, and I sold some puts on Tesla because I felt like the valuation level of all those companies a few weeks ago was within reason. And remember, I only sell puts on companies that have a durable competitive advantage. They have a moat, they have pricing power, they're cheap, and I'm okay to hold them for the long run. So right now it's definitely, more slim pickings out there right now. But as we have volatility in the market, whether we have upside or downside volatility, I'm always here ready to capitalize. So if the market goes way up, I'm going to win. If the market goes way down, I'm going to win too. There's really nothing that's going to happen right now to where I could potentially get wiped out in my portfolio. So I have a really big announcement to make, and now my course and my Discord to come in is all going to fall under one membership for $29 per month. So you're going to get access to my entire stocks and options course, plus Discord, which features weekly Zoom, market updates, trades, research, breakdown, stock sheet, and so much more. And I just launched this just like a couple hours ago, and already 84 people came in. Already got a couple really good reviews right here. You could check that out. But all of that is going to run you $29 per month. You could do it for a month, and then you could cancel. Do whatever you want to do. So if you're interested in that, click the link below. It's all going to go through WHOP, W-H-O-P. You join on there. It's going to give you Discord access, and the course is on WHOP now. It's going to totally blow your mind. I'll see you guys there.